Simon Hillenbrand, who's head of UK sales, joins us now to moderate this session, and he's joined by Tom and Laura. Hi, everyone.
Thanks, Laura. Welcome, everybody, to the session, which is we're going to be covering European and UK equities. Perhaps two of the less favoured asset classes of the last couple of years, and we'll have a look at that. But yes, I'm delighted to be joined by Laura Foll from our Global Equity Income team, who manages a number of our UK equity income open-ended and closed-ended funds, and also Tom O'Hara from our Continental European Equities team. So two people who are very well qualified to talk to us about what's going on. So let's get started. Clearly, as we've heard from Lucy, COVID rates or COVID infection rates are dropping off. We could be now much closer to the end of the pandemic than the beginning. So let's talk about investing. Laura, how is the UK faring now that we're perhaps towards the back end of this pandemic?
I think the key thing to always remember for UK equities is the context, which is that just how much the UK has underperformed other global equity markets over the last 5 and especially the last 10 years. I think if you looked at most global equity markets, they would have underperformed the US, but the UK has also underperformed continental Europe by a material amount. So the valuation context is always key, and the UK is starting from a point where we're at one of the biggest discounts to the MSCI World that we have been in 20 or even 30 years on some metrics. So that's the valuation context. Now, interestingly, when you look at how we've done calendar year 2022, and I appreciate this is over a very short time horizon, but the UK has started to outperform, and the UK is actually one of the only global equity markets that is up this year. And interestingly, that's been led by the very sectors that have caused the UK to underperform on a longer term time horizon. So the likes of oil and gas has performed well this year, the likes of banks. So interestingly, there does seem to be a market where the UK can outperform, and it seems to be that in an environment of rising interest rates, we've had 2 interest rate rises already here in the UK, and inflation surpassing expectations, that seems to be a more positive backdrop for UK equities. Now, clearly, as I mentioned, this is only about a month and a half that we've seen this now, but it is encouraging to see that with a change of economic backdrop, it looks like UK equities can begin to outperform.
Great, thanks, Laura. And Tom, how's 2022 going for you guys in European equities?
So far, it's been pretty good year to date. I mean, we had a pretty miserable last 6 weeks of 2021, so it's a bit of a blue Christmas, really. But all of that lost alpha as anything sexy, ESG, growthy just got more expensive into the 31st of December. Probably because, it's an element of risk off in response to Omicron headlines and various people across the industry who get paid based on their performance as of the 31st of December deciding to close their books. So you had a lot of odd movements that were pretty tough for us because we're a bit more value, a bit more reopening tilted. Year to date, it's been proper revenge of the filth. It's been pretty good for us. And it's all of those sectors that Laura mentioned, it's banks, it's oils, miners, supermarkets, all of those things actually that are good, reasonably priced inflation hedges. Now, let's see if it carries on. Value rallies can last about 2 hours sometimes, and so this has far exceeded expectations in being more than a few weeks. But let's see, given the rate cycle and the increasing acceptance from monetary policymakers that inflation is less than transitory, then this could go for a while.
Great. Well, good to hear that both of you are having a slightly better time with things. We can't really avoid inflation. It's certainly back. It seems to be on the rise. We have, unfortunately, a much heralded and fast approaching cost of living crisis coming to many in the UK. Our investment trust colleagues here at Janus Henderson have been doing a lot of work on investing for retirement. And the latest survey they did showed that over half of respondents who are 55 years or above have not actually or are not planning currently to adjust their portfolios to allow for inflation. So with that in mind, how are UK and European equities positioned in your view? Laura, we'll start with you, please.
I think you're right to mention equities, because I think one of the main things to remember with inflation is that if you're holding companies that have pricing power, they at least have the potential to pass on rising cost pressures that we see in a more inflationary environment. So they at least have that potential scope to grow earnings and, in case of an income fund, dividends in line with inflation. So I think equities is definitely the area that I would be focusing on in that more inflationary environment. I would say beyond that, it's important to look at what's causing that inflation. So what we're seeing at the moment, for example, is commodity prices are a lot higher than they were a year ago. And there are large sectors in the UK that can very directly benefit from that rising commodity price, oil and gas being a prime example. And we've seen that with the Shell and BP results over the last couple of weeks, which have been very strong, and we've seen the headlines here in the UK about that. So there are, as an asset class, you would think, well, equities would be potentially better protected against inflation, but within that, there are sectors that can very directly benefit from that more inflationary environment.
Yeah, I'd agree with all of that. I think all of the sectors mentioned, banks, miners, oils, supermarkets, they are effectively able to pass through inflation to the most part, sometimes with a lag. So if you're thinking about your overall savings, your overall portfolio, then that's a much more attractive proposition than cash. Effectively for equities, it should be a pass-through in time. And then the other thing to consider, which is a bit of a paradigm shift, if you think of the last 10 years, where valuation didn't matter. The price you pay now, I think, does matter. So that's one of the other tricky aspects of this consideration of pricing power in stocks. There are many, many stocks out there that have unquestioned pricing power, but they can also be very expensive from a share price point of view. And that can come under a little bit of pressure if you're going through a rising rate environment. So I think it's finding that balance of what's a good inflation hedge, but what doesn't cost the earth. And Europe is a really good place for those sorts of stocks. It's not been quite as unfashionable as the UK. Sorry, Laura, but it's not been far off. So, these two dogs are potentially having their day again.
Great, good to hear. Thank you. Obviously, we can't really talk about Europe and UK equities without touching on the B word, Brexit. 6 years post the death of David Bowie and the referendum of 2016. How has it been for you, for both of you as investors in European and UK equities? What do you think has been the effect on investor sentiment towards your markets? What's changed, if anything?
Well, it's been a tough time adjusting to life without David Bowie. I can confirm that. But for the most part, certainly from a continental European perspective, it's not been a huge consideration ahead of the time and ahead of the potential trade frictions that would occur in the negotiations. If you're on company conference calls, they'd be mentioned a bit, but by and large, the European stock market, certainly at the sort of mid to large cap end of the spectrum, consists of companies that are global companies, and the UK is a blip in that. So it's not a huge consideration. I think the only thing we're wary of in terms of our UK exposure at the minute is Brexit and the frictions, the trade frictions that it brought were probably the last thing we needed when we had the COVID-related frictions. So shortage of truck drivers across the continent, but especially in the UK, makes it harder to get goods through, creates more price inflation. So that the cost of living squeeze in the UK is arguably a bit more of a pressure point than it might be on the continent. And I think that's why recently you've seen certainly some of our UK consumer discretionary exposure just starting to wobble a bit, because there's a clear worry that actually the cost of living crisis is a worry for this year, but possibly especially for the UK. So within that, we have to be quite selective about how people will prioritise their disposable income. And we've basically taken the view that mid-market, mass market stuff probably suffers the most, but people will still be gagging for a holiday.
I would agree with all of that. I think when I'm thinking about whether the inflation environment, as Tom mentioned, I think we've reached the conclusion that it's not transitory. But when I think about how long that inflation is like to remain in place, for the UK specifically, we do have a very tight labour market after Brexit. We're talking about unemployment, 4% or lower. And I think if there were to be a risk of that wage price spiral starting, we are starting from a very tight labour market in the UK. And so will those people actually go to their employer, opposite of what Andrew Bailey said, and say, yes, I do want that real wage increase, thanks. There's not many people that can replace me. And actually, if we're thinking about whether that inflation dynamic can stay, I think there's potentially a higher risk of that in the UK than there is elsewhere. And I think Brexit is one of the key causes of that.
Thank you both. So another big subject of the day, Russia and Ukraine. How's that impacting on your thinking, or what are you hearing in the markets? Doesn't appear to have had a lot of impact yet.
I think the biggest potential impact that I'm thinking of is similar to what we were just talking about, actually, in terms of, is it going to cause more of a cost of living squeeze than we're already seeing in the UK? The gas price, everyone knows the UK gas price is already at very elevated levels versus where it's been historically. We've already seen the oil price go up considerably year on year. So we're already in effectively an energy price crunch. And what I'm thinking about is, okay, if these tensions do increase, could those prices go up further? Is that priced in yet? And could we see even more of a squeeze than consumers are already seeing on their real disposable incomes? Now, I think Tom made a really valid point that valuations do matter. And what we've already seen across a number of consumer discretionary stocks in the UK, whether it's Next, whether it's M&S, is that they have already underperformed quite materially this calendar year. And that makes it more difficult to judge whether this has already, to a degree, been priced into some of these stocks, that people will see that wage pressure. So you've got to always think about the valuation context as well as what might be coming in terms of pressure on real disposable incomes.
Yeah, I've been surprised at how sanguine the markets have been overall. Like, you've not seen stock markets in general get into brace position, getting war ready. Perhaps it's been a contributing factor to oil and gas stocks doing so well. But that was that whole outperformance of the oil and gas sector kicked off late last year before we really got into this Russia-Ukraine standoff. I think the most interesting thing for me out of this Russia-Ukraine crisis is that I think it's going to help move the ESG narrative along a bit, because it's going to highlight how dumb it is to be reliant on Russia for 40% of Europe's gas needs, while simultaneously cancelling Western listed oil and gas producers. Security of supply, turns out, is quite an important consideration, especially with regards to costs to the consumer. So hopefully, in the last couple of days, the news flow has been quite interesting because of all these calls for windfall taxes on BP and Shell in the UK, who barely make any profit in the UK. So that'll be quite interesting to see how that works. But despite that, I think there's more nuance coming to the energy transition now, in terms of we've got to weigh up a few things here, and it's not just, whip the polluters. It's actually, we'll make sure that people can heat their homes at a reasonable price.
Yeah, that's a very good point. Talking about ESG for a minute, and your point about oil and gas. You and your team have been quite vocal on the need to think about the transition as opposed to the cancel. What are you seeing in terms of the transition and investment opportunities at the moment? Yeah,
look, I think that this whole concept of ESG by exclusion is morally feeble. I think it makes absolutely no sense from a societal perspective or from the perspective of looking after your client. And the way you look after your client is to make sure that you analyse and exploit all attractive risk-reward opportunities. And if you start segmenting the market, the opportunity set, based on a very sort of binary moral framework, then you're probably going to miss out on some of those opportunities. From a societal perspective, if you think about the emitters, they're the ones that bear the greatest burden in ensuring there's an orderly transition, and an orderly transition that, again, doesn't cost the earth to the consumer. So what's important in that context is that we have responsible, accountable, Western listed custodians of these assets. And then most importantly, they need shareholders who are engaged. So I don't see how it makes any sense for anyone for you not to be at the table engaging with these companies. And that's the view we've taken. And in Europe, we're lucky enough that we've got a number of what's screened today as big emitters, but actually they're leading the charge on the technological solutions that are needed for the transition. So we've got oil and gas, you've got Total and Shell plowing billions of dollars into renewable power generation, new technologies, you name it. And then we've got, Holcim, a cement company, leading the charge on decarbonisation of cement. We've had ArcelorMittal, the world's biggest steel producer, ploughing billions into hydrogen-ready facilities. So, they're doing their bit, and actually that's where the biggest impact will occur for society. So really what we're doing isn't... I'm always surprised by how controversial our views might seem at times, because actually we just think we're aligned with what society needs as a whole, which is balancing the requirements of a number of stakeholders in an orderly, pragmatic way.
That's a very interesting point. I think there's a lot of discussion now about the need for these companies to remain in the public eye and not to disappear to other people who maybe won't do necessarily the right thing with them. Laura, how are you seeing this as a theme in your portfolios?
I would agree with a lot of what Tom said. I think part of our job as portfolio managers is to make sure that your portfolio has balance to it. And what we've seen this year is that there can be times when commodity prices go up materially, and there has to be a portion of your portfolio in that kind of environment that can actively do well in that environment. So I think that's the first thing I'd say. I'd say the second thing is we agree that the oil and gas companies do have a role to play in this transition. I think people are increasingly recognising that. They have substantial cash flows from their existing businesses that allow them to invest sometimes even more than some of the specialist renewables companies in this area. And they also bring very specific project management experience with large infrastructure. Shell, for example, is actually one of the biggest retailers in the world. So it is in a very good position to put electric vehicle charging points across its very large retail network. And I think that's increasingly being recognised, that these companies shouldn't be excluded. We should be sitting down at the table with these companies and having this debate. And I'm really encouraged that the debate seems to be becoming much more nuanced and much more pragmatic, with a recognition that, yes, we need to transition. Of course we do. We also people need to afford to heat their homes right now. And there has to be a gradual transition from A to B. And unfortunately, we can't wake up and go to B. There has to be that transition.
Good stuff. Thanks, both of you. We're drawing towards the close of this session. We've covered quite a lot, I think. But perhaps reasons to be cheerful. Where do you both see interesting opportunities for investors as 2022 rolls on, and what we know at the moment gives us a view of what's ahead? Clearly, the world's a strange place, but what do you think? Where are the opportunities?
Yeah, I might start with just saying the UK. I think the UK as a whole, there is that valuation discount that remains in the UK. We have, as I mentioned, slightly outperformed year to date, but in the scheme of things, on a 5-10-year horizon, we've still very materially underperformed, and that valuation discount remains. You can also, despite the dividend cuts that we saw in 2020 in the UK market still pays just under a 4% dividend yield, which would still be notably above, for example, the US market, and also, sorry Tom, a bit above the European market as well. So rather than getting too nuanced and complicated, I would actually just say the UK as a whole, maybe it's time for people to turn back and look at the UK as an equity market.
I agree with that. I think the UK is really interesting from that perspective, and Europe's the same, because it's not dissimilar in its makeup. I think in a world where you do have inflation transitory for longer, or whatever iteration we come up with next, higher interest rates, valuation mattering again, then Europe and the UK are good places to look at stock picking. And especially on top of that, we've just talked about, if ESG does become a bit more nuanced, as it feels like it is being, then companies that for a couple of years now have probably been perceived as uninvestable become investable again. So again, the opportunity set is there. And I guess on a sector basis, I'm quite intrigued at the minute by the market starting to think about pricing recession. I've got 20 seconds to say this, so this is going to be a challenge. The market's trying to start pricing recession. But when we speak to all of the companies we speak to, the outlook for construction in Europe and the US, the backlog of work that's not yet started, is massive. And it's helped by a lot of these green measures, energy efficiency schemes and so on. So there's probably going to be a lot of activity in that space over the next couple of years done.
Great. Thank you, folks. That was great. We covered quite a lot there. Lucy, I'm not sure if we have any questions or even any time for any questions.
We've run out of time, but I'm really pleased to say to you all, well done then, Tom, because actually one of the questions that came through, and there was more than one on this, is where the opportunities are and whether construction is coming back. So I think, Tom, you dealt with that quite neatly and nicely at the end there and answered one of those key questions that came through. But thank you all. Simon, Tom, Laura, really good to hear your thoughts. Thanks so much.